Investors and traders, welcome to the channel. Today is 9th of June 2024. I hope everyone is having a great weekend. In this video, we will be taking a look at the US stock market and key US markets such as the dollar index, bond markets, brief look at the gold, and then we'll take a deeper dive into the US stock indices. Unfortunately for this video, we will not have the time today to look into the sector analysis that we normally do for the weekend. So it's going to be a little bit shorter video. So as always, this video is for educational purposes only, and it is not a financial advice. Okay, so this past week, especially Friday, we had the economic data of non-farm payroll come out. Now the non-farm payrolls were higher than expected, so more jobs were created. So in a way, it's a good news, but again, the market took it in a way, which is that the Federal Reserve is not likely to be quick in lowering the interest rates. So we saw a mixed kind of a reaction in which what we have seen is the dollar going higher, the yields rising, and we have seen certain stock indices move lower, but then we have also seen certain stock indices actually move higher, such as the SP500, the NASDAQ, the Dow Jones keeps on lagging, and the Russell 2000 is also lagging. So it's kind of a mixed picture out there with regards to the indices. And we really have to look at all these things together to understand how the money is flowing. So it was really an inflection point for me last Friday because the dollar was so strong and the yields actually rose. And our analysis, if you have been following us, is that we were looking for a top at 107 in dollar index, and perhaps over the course of a few weeks, lower prices. But again, we'll just discuss those in those respective charts in more detail. But really, last Friday has been a point where I began to kind of look at our whole hypothesis one more time, that it could really be an inflection point, and we could be seeing things play out a little bit differently to the way we were anticipating things to move actually. So really key price action that took place last Friday. With that, what we are looking at is the cash chart for the Dow Jones. This has got our timing model that we have been following. It has done a pretty good job. I'm not going to do a detailed analysis of how it's being constructed on the channel. You can find past videos where I explain how it's constructed. Now we had a major date coming on around the 30th of May, around 29th of May, with 2 to 3 trading days either side. We saw a very nice low come in, and then the market rallied, really strong on 31st of May. This was kind of what the model was telling us, to find the lows in that region. And now we have a minor timing coming in that's based on this cycle. So the cycle topping around 1st of April or between 21st of March, depending on the kind of index you look at, but we are following the Dow Jones Cash Index. So last Friday we had this minor timing coming on the Friday the 7th of June, and after that we have another minor timing coming in on the 21st of June, and finally the bigger one on the 1st of July 2024. So the way I see it is that, look at the Dow Jones Industrial, you can see that the S&P 500, we'll take a look at this in more detail later, is actually making new highs. Dow Jones is clearly lagging. And so I think we are entering a time window where I am expecting all of these different indices to kind of resolve by the end of June, beginning of July. That's where we have the major timing. But as far as this minor timing is concerned, we could see sideways to downward price action for certain indices such as Dow Jones. But as long as Dow Jones is above the 78.6% retracement, the bigger trend is still higher. But what we could see is, it's still a lot of points. It's about 700 points if we retrace down to about to the bottom of this the candle of 30th of May compared to where it closed last Friday. So we could see these wide ranges, price action in Dow Jones, and some other indices as well. And the chances are that next Monday to Tuesday we might in fact begin to see a sideways to a further pullback actually taking place, because we have got the timing coming in, and also the Dow Jones Industrial closed negative last Friday, and it keeps on closing. Let's look at the retracement of, I think it retraced about 50% of this move. Yes, it did retrace about 50% of it. So unless it begins to show further strength, the chances is sideways to a further pullback, and we would expect the 78.6% retracement to still hold, and this market just turn around in this trading range with the next couple of trading days having a bias to the downside. And one of the reason I'm saying this is that while some of the indices were making new highs, as someone actually sent me this chart, this is an advanced decline line chart with respect to New York Stock Exchange, and we can see the SP500 E-mini futures actually going and making new high last week, whereas the New York Stock Exchange advanced decline line is declining. So there's a divergence there. So what it means is that the price action is actually in a handful of stocks, and in terms of the breadth of the market, that really needs to improve, so that there is a wider participation taking place in the marketplace. More and more stocks begin to make new highs or close higher for the days and the week, and then that's where the buying in the overall market, or the buying actually begins to broaden in terms of improving the breadth. Otherwise, there is a lot of price action happening in a select few stocks. This is Nvidia, Apple, for example. Nvidia is going to go through a stock split. Maybe there's some action in that. Then also Apple closed really well, did a video on the tech stocks, so have a look at that. I'll put a link to it towards the end of this video. So Apple could be one of the reasons as well. Still a big major player, and it has quite a lot of weighting in certain indices. So yeah, this is another reason to be aware of. And also, if I show you this New York Stock Exchange advanced decline coming in from stock charts, we can see this red line for last week. So this just shows that it wasn't a bullish close. It's an inside bar kind of formation. So the number of majority of the stocks were actually closing lower for the week. So and if you stick around till the end of the video, well, I will also give these daily and weekly ranges. We are expecting the market to move next week and tomorrow, i.e. the 10th of June. So I'll actually put this in the description as well. And I'm not going to go into the details how these are calculated, but do pay attention to especially the weekly ones. +1 and +2 standard deviations, ES and NQ in particular. Alright, okay, so with that, what we are going to do is we'll move on and start taking a look at the dollar index. So here we go. This is the daily chart of dollar index, and look at this. What a candle formation! Such a bullish looking strong candle. This is when the FOMC, the non-farm payroll data came out. We have been looking at this double top formations here. We think 107 is a pretty strong resistance level, but this is really an inflection point where we could in fact be looking at a possibility for the US dollar to move much higher. So I'll just move on to the weekly chart to show you that, but where we are right here right now, such a bullish looking candlestick bar. What could negate this is actually a pretty strong, or actually a pretty deep retracement of this bar. That would indicate that there is still quite a lot of weakness here. So moving on to the weekly chart to show the kind of what we could actually expect is, we have been working with the assumption that this point 107 is a pretty strong resistance level, in fact a top where we could in fact be looking at an ABCD moving lower for the US dollar. But what could in fact be taking place is that as long as this point is held, it might actually be a B point, or A, B, C, D. So we could be having another, let me change the to red here. So we could have a situation where this could in fact be point C, and let me draw it like this. Here we go. Which could see the price move to 108.65 to as high as 109.85, and just above that we have the 1.618 expansion as well, and hovering around here is also the 78.6% retracement, which I haven't drawn, but the likely chance, the likelihood will be, if this turns out to be point C, 108.65 is something which we will be looking at as a possibility. That will be 1.272 expansion of this range, this swing. Then of course we have the 61.8% retracement as well. So a really interesting one to take a look at, how it's gonna pan out. And if, for example, we do not, we actually close below 103.50 level, then that means that US dollar is actually going to go much lower. Then we'll have a ABCD, ABCD print, or at least we'll have something like this. Here we go, projected from here, and it's gonna bring us right into about 99.75, right into this region that we have printed for a long time, which has been on the chart for a long time. So really an inflection point, which happened last Friday, and it's just incredible how volatile the markets were. We'll have a look at the long bond futures in a moment, but that moved 2 points, and the euro, or the dollar, rose against the euro by one big figure, so 100 pips, maybe a little bit more. So it's really at an inflection point, in my opinion, that certain things that we have been working with, they might be actually getting challenged. So we'll have to look at the price action to really evaluate that. So I'm gonna put a question mark here, because I don't know whether it's gonna be moving in this ABCD here, or whether the market actually forms an inside bar and may actually 103.50, which will be preferred scenario, is broken to the downside, and then dollar begins to move into the 195.75 region. And if this is held, this is potentially a point C, and this could see a 108.65 and as high as 109.85 for the dollar index. So I think next week is going to be really key, and we'll get a lot more information about what sort of pattern to expect. Now, moving on to the yields towards the shorter end of the curve. Here we go. Look at this, such a big move in the yields, right? The low was around 4.73, and the high, it went to 4.88. So that's a pretty strong move. And when you have a move like that, the chances are that maybe there is going to be continuation. However, we have also been looking at this pattern formation, that there's a possibility of this head and shoulder pattern in play, and the yields moving lower. So next week, I think it's really important. We should begin to get further information how the market is actually going to trade, especially the notes and the bond markets. We look at the futures for the long bond future. Now we'll just move to the longer end of the curve. This is the 30-year bond futures chart, and we were really looking at this CD, and we were assuming that because it broke above this channel formation, broke above 118.22, that it's moving in the CD leg. Now last Friday's price action, it actually moved lower to 2 points. That's quite unusual for bonds in such a big market, and this kind of reminds me the moves that we have seen in the past, such as the move from here, and maybe a move like here, where we saw then this move continue to the downside. Um, of course, we have this ABCD formation. This has been there on the chart before, so it came in pretty right at the spot with regards to the ABCD. Now, what I have not got on the chart is whether there is some retracement around here. So let me draw the retracement. And yeah, there was about 50% as well, but in fact the price went a little bit higher. But we were really looking at this channel formation. Now it has actually moved back into it. Now couldn't find support from this channel formation, so we'll see next few trading days whether it just begins to coil around here, reject lower prices, and some buying begins to come into it, and then it begins to move higher, and that will be our preferred scenario based on the macro that we're looking at for the summer of 2024. So really an inflection point last Friday. I mean, the markets were really volatile if you were watching them on an intraday basis. Okay, so this is what we are watching here. 20-day period moving average right below that. Let me see what sort of retracement are we talking about here. Whether it went right to the 38.2%. So yeah, there is some hope, and hope is not a good word because it's 38.2% retracement. There is this channel which could, once resistance, might become support, but we need to pay close attention to the price action next few trading days, okay, for the bonds. Now, let's begin to take a look at the gold market. So the gold market is really interesting because it actually began to move a little bit earlier, or kind of in advance, because the news that came out was the Chinese authorities came out and said, okay, we are done buying gold for some time. Well, of course, I mean, that's why do they have to tell the entire world about their plans, right? They never came out and really pointed to the world. Oh, okay, we are starting to buy gold back in February around here. So why come out and say, okay, we are going to actually be not as aggressive in buying, but we'll still be buying. Of course, that's gonna bring the prices down, so it's better to buy at lower prices, for example. Whenever they begin their buying program again, but they're not gonna let us know. We'll just find out through the price action. Now, the thing about the bull markets in commodities and the bull markets in stocks, for example, the big difference I find is, and I treat gold as actually a commodity. It's something which you can pretty easily trade. It gives you good movement on daily basis. In fact, when when a bull market in commodities starts, as commodities begin to increase in price, that in fact decreases the demand. And the reason is that, for example, if it is cocoa or if it is coffee, the companies which are actually using these commodities to produce their products, to make chocolates, to make coffee, like Starbucks, for example, selling coffees and stuff, for them, their costs begin to increase, and it could reach a point where either they'll have to up their prices to the end consumers, and the end consumers could actually reduce their intake, so the demand begins to go down, and that's why the commodity prices then could come pull back as well. Whereas in equities, what we see is that when a stock begins to move higher, it's actually creating more demand, because more and more investors will begin to come in and begin to pile, because the business is theoretically beginning to do well, in the sense that the earnings will be rising, the revenues are rising, and because of that, there is going to be more profit available. So of course, the shareholders, whoever is going to buy that, is likely to benefit through a company which is generating good revenues, is generating earnings, and this is how the business is growing. So that's how I look at these two different markets, and from a price action perspective, they move slightly differently as well. But that's a topic for another day. Okay. Now, so what is key here? The gold actually closed below the 78.6% retracement. This is about $100 move. It's not usual that gold has $100 moves, but it did, right? So the chances are we are gonna see some sort of 1-to-1 ABCD like this. So perhaps it's gonna go and challenge these lows around here of 22.85. I believe that's where the low was, somewhere around here. Maybe make a slightly lower low. Now that's really interesting, and we'll have to wait and watch for the price action. We've got another timing, like kind of a minor timing in my opinion, coming around 14th of June. So interesting time for gold, and silver was also pretty volatile and actually closed lower for the day. But the fact is that we were looking for some timing and support to come in, but the 78.6% retracement was actually broken to the downside. Still hasn't taken these lows out, but again, it remains a range bound market. The chances are for a while gold, because it has had really fantastic gains in 2024, it just begins to move in a pretty wide range, between 2200 to 2400, $200 range is pretty large for the gold market. Okay, now we'll move on to the S&P 500, and we begin to take a look at these individual markets. Now I'm gonna move over to the weekly charts for these, and here we go. We can see a positive close for the S&P 500 cash market. It came very close to the 1.618 extension of this CD leg, and that could be another reason that we might actually see some sort of a pullback. I've not shown the expansion of it on the weekly chart, but let's actually go back to the daily chart. You can see that 1.272 is this expansion. So we are at those levels in terms of price where we have some minor timing coming in, and we are right at those price points as well. So we could see some sort of a trading range behavior, maybe a slight pullback as well. Okay, so that's what we are looking at in terms of S&P 500 cash. ES, this is the S&P 500 E-mini futures. Look, it hasn't done the 1.272, but the cash has. Still got the chance to actually do that, but again with the timing and the cash being at that 1.272, maybe just go and retrace a little bit lower, touch this bottom of this price bar, right, at a 20-day period moving average, but eventually, in my opinion, the market is likely to resolve to the upside. So 54.40 is kind of the region that we'll take a look at, and then maybe at some stage we'll have a bigger pullback because what we see is the breadth is just not there. We have this divergence, right? So really key how the price action is going to unfold. If we begin to close below the 20-day moving average, that's not going to be good for the price action, and then that could potentially be a double top formation and could lead to a further pullback. So yeah, interesting times. I think the next couple of weeks when the markets could be pretty volatile, the stock market. Okay, now let's take a look at the NQ. And here we go. This is the daily chart. It's also right at the 1.272. Some sort of consolidation is expected here, and this is what we have seen. Maybe it can also pull back right to the 18,700 level as well, where we have the 20-day moving average. And the bottom of that bar, and here we go on the weekly chart for the NASDAQ. And the chances are, the longer term, what we're really looking at is this market to go and complete this big ABCD around the 20,700 mark. And I don't know what will happen when the market will get there, because that's a pretty big level. We'll have an ABCD completing, and we'll also have the 1.618 expansion of this entire bear market. That's a pretty strong level. But between that and now where we are, there are these minor levels, and so I believe 19,700 is also a stronger kind of a resistance level. Certainly one of the targets has been met, which is 1.272, and of the market actually next week, especially in the earlier part, Monday, Tuesday, pulls back somewhat. It's kind of expected. It has had fantastic the fantastic gains here. The key is that this week's low, which comes around 18,260, we should not begin to close below that and below the 20 period moving average as well, 20 week moving average, because that would indicate the market is actually pretty weak or getting weaker. Okay, so this is for the NASDAQ 100. I'm not gonna go and look into the QQQ or the XLK because I already done a video about it. So please watch that. I will put a link towards the end of this video. Now we'll take a look at the Dow Jones. This is the Dow Jones Industrial here, but through the eyes of the E-mini futures, not the cash market. We can see there is kind of a double top formation around here. It's not a confirmed double top because it hasn't taken out these lows. Let me point a thing here, and so I think it's just gonna be a pretty range bound market with the bias, especially in the early part of the week, to the downside. As long as it's not closing below the 78.6% retracement, which is about 38,060, I think it just moves in a range, and then eventually, when the timing is resolved, it just begins to move higher, and all these indices begin to resolve. It looks like a rotational correction to me, where certain kind of stocks are doing better in the kind of environment we are from an interest rate perspective and the expectation of the interest rates compared to certain kind of stocks. So this is what I think is actually going on. It has the potential to reach 42,000, which is the 1.61 expansion of this bear market. Now the thing is that it had also completed this bigger ABCD around here. So this kind of price action, where it's actually gone in a pretty wide range, is kind of actually, it's not too bad in my opinion. But again, what really concerns me is also this kind of breadth. So it's actually a certain handful of stocks which are really driving the price action higher. Now we'll take a look at the Russell 2000. Now this is really weak, because for 1, 2, 3 consecutive weeks it's just closing negative. The week of 20th of May, where we had our timing and we saw some indices rally really well. This one remains range bound. And now it's actually price closed before, lower than the 20 period moving average. So this is something, from momentum perspective, it's not improving. I think it'll just keep on bouncing in this range. It's gonna be a pretty wide range till 1930s at the bottom of the range. It has done this before. You look at this really wide range. It was there in this range from 15th of August 2022 till it finally made an attempt to break it down around the end of 2023. So really long time, and it could do the same thing. And as long as this point, which is 1920, is not broken to the downside, the chances are it might still actually be in this ABCD higher, but it might take a long time for it to resolve. And these Russell 2000 stocks, they are smaller stocks. Their balance sheets likely get hugely impacted by interest rate movements because their costs begin to rise. So yeah, I think we will be in a pretty range bound market, quite wide ranges, which could be pretty uncomfortable as well. We could some actually may begin to argue we are forming a head and shoulder pattern with the left shoulder ahead and right shoulder. And in fact, we might just be trading in a big range, because this is what we have seen here as well. People could have argued, a left shoulder, head, right shoulder, but it never broke below these necklines around here. So I think we are entering this kind of environment again until eventually we begin to resolve the expectations with regards to interest rates, and interaction comes into the play. That will be really interesting. While we are at, and yeah, let's actually take a look at IWM as well, which is going to be the cash market for the Russell 2000. Similar kind of price action that what we have seen in futures, but these are a little bit stronger. Now let's take a look at NYA, New York Stock Exchange Composite Index. So here we go, a very similar kind of price action to Dow Jones. The chances are that as long as it stays above 78.6% retracement, we might see 1.272 in this one as well, and a little bit higher to complete the ABCD. Now this one also has ADRs. This is the reason we like to take a look at. It's about 2,000 plus stocks, including the foreign stocks as well. Moving to the dollar index one more time, just to see that why the dollar has been so strong from a kind of a fundamental perspective. So this is coming right from the George Soros book, Alchemy of Finance, as far as I remember reading it quite a long time ago. And one of the things that stuck in my mind was when we have a fiscal policy which is loose or expansionary, and also at the same time we have a monetary policy which is restrictive, so in other words the interest rates actually moving higher, then the value of the currency is bound to rise. And that makes sense in that, here we have a fairly restrictive monetary policy where the interest rates are in the 5.25 to 5.5 range, because the Fed fund rates fluctuate in a range. And on the fiscal side, it's still, it's not really out in the public that much. But if you begin to look at certain things, the kind of aids are being given out, or maybe expenditure, etc. Fiscal policy is still fairly loose, and with that impact coming from fiscal policy and a tighter monetary policy, the dollar has been pretty strong and resilient. But on the other hand, there are certain geopolitical factors that might be coming in as well, because of the instability in a number of regions, Europe and also recently Middle East, for example. There could be some inflows coming in where the US denominated assets being bought, such as equities. So of course you need dollars to buy those. So there is some demand factor coming in as well. So all these things kind of play together hand in hand. But the narrative is likely to change if we begin to go towards a path where the monetary policy will no longer be restrictive, and that could just start with just one interest rate cut, and that kind of perception then could lead to the markets looking at this model not being carried forward. So the monetary policy becoming actually not as tight, but rather expansionary, rather than being a tight policy, so rather loose policy, just starting that cycle. And that would actually begin to make the dollar go lower. And this is why when we look at the technical picture, this is one of the fundamental reasons when we are building this technical picture, that these are the fundamentals that could be behind it. But that kind of changed, well, it didn't change, but it's an inflection point last Friday, because the kind of strong number that came out of non-farm payroll, and if the Federal Reserve is going to take a look at that, and they might dissect it and find out, okay, certain kind of jobs are being created, but it could be, maybe it's because of summer, those are in hospitality, for example, and they might still come back and say, okay, strong number came out, but we are still sticking to at least one rate cut, for example, but it might just get pushed out further into the end of the year, but 2024 might still get at least one. So the further it gets delayed, in my opinion, we begin to see a strength in the dollar, just because of the fundamental reason I've mentioned, and the technicals will begin to tell us, by strong looking candlestick charts. So this is what we are looking at. So thank you very much for watching the video. And if you found this video of educational value, give it a thumbs up. If you like our analysis, how we look at the markets using pattern recognition, Fibonacci ratios, extensions, expansions, projections, then please do subscribe to the channel as well. Apologies, not able to do the sector analysis in this video because this video is already pretty long. But wish you good luck, good trading, and speak to you guys soon. Have a great weekend.